Hi, this is Dustin with Dustin's Dollars. Today I'm going to be talking about Knightscope and talking about my bull case for the company in 2024 and beyond. I'm mostly doing this to really give a little more detail to a comment that I got in my last video. I'm going to read it real quick. They said, I liked your analysis at the beginning, but at the end, you started to lose me when you tried to find a path to profitability. I think your assumptions at that point were just too far from today's numbers for me. Here's a company that really isn't growing the ASR business. They lose money on each one they make. They spend 3 times revenue on expenses. So what makes you think they are going to overcome those 3 things to magically become profitable? Because they said that they can build 3 a week now. They haven't signed deals for as many as they could build for years. What makes you think they're going to find profitability from such a far behind position? They aren't even close right now, and they've been at it for a long, long time and haven't gotten any closer. I'll try to take a critical look at my own pessimism and maybe you can take a critical look at your own optimism. So first of all, this is from Dignity Lifts. Thank you very much. This was, it was a really good comment. Really good questions, and I wanted to explain my side. And I will admit up front, it is a very optimistic view because what Dignity Lifts here said is not wrong, right? All of these facts are true, I think, and the company, the historical results for the company look pretty bad, right? And so I'll even sum that up real quick. Here, before I begin in earnest, let me give my standard disclaimer. I'm not a financial advisor or a financial professional of any sort. All opinions I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in Knightscope, so this video should be for your entertainment purposes only, because I could be wrong about everything I say in this video. You need to do your own research before making any investment decisions. So again, I will reiterate the bear case, because the bear case is really easy to make. The company is losing money, and every robot that they deploy loses them even more money, and that right now they have to fund the company through, they need more capital, they have to fund it through dilution, and sooner or later they're gonna not be able to do that, and the company is going to go out of business, right? That is the clear bear case, with a huge emphasis on the, they lose more money with every robot they deploy. Their gross margins are negative, things look awful. So like, it's, how could anybody ever even think of investing in this company? So what I want to present today is, sort of the flip side of why I think, you could actually be bullish on this company, why I am bullish on this company, and what I can see in the future that is not reflected so much in the, the prior performance of the company. So, but I will start off by saying, the bear case is not wrong. It is based in the facts of the prior performance of the company, and it is a very, very high risk investment. I have, sized my position in the company appropriately so that if I lose the money I invested, I am not going to go bankrupt. It's money I can afford to lose, as I say, and Knightscope is a very high risk investment. So keep that in mind. Now, here's the thesis, the overall thesis for the bull case, right? Number one is this slide from their investor deck that, spells out the actual core value proposition of the company for the clients. And that is that, these robots work to reduce crime. They are a deterrent, and they are cost effective in doing so, that they are cheaper than, in general, cheaper than a security guard. They have capabilities that security guards really don't, in terms of, one of the big ones there has been monitoring parking. And, that is, I think, the core value proposition for the service. From the investor side, the market for this service, I think, is very large. It's, comparable to the market for security guards, which, there are millions, I'm guessing, of security guards in the United States. Quite a few. It's a large market. The new K5 that they are deploying has improved margins. So I think this is something you haven't seen in the past that we'll see in the future, where these margins will improve because the newer K5 is, it is more well designed. It also fixed the production bottleneck so that they can actually deploy these things, right? They've had this big sales backlog in the past, and I think they're going to clear that sales backlog, actually get the robots deployed into all those contracts that have been signed, are going to now start turning into revenue. And then having that, not having this huge backlog is going to then let them make new sales and deploy these much, much faster than saying, well, okay, cool, you're now in the backlog. You're gonna have to wait months and months and months before we can actually ship your robot. And I think with that is going to come scale, right? As they both clear the backlog and they have more robots deployed now, or very quickly, and then as they sell more and are able to deploy those, that scale is you're going to see much higher fixed cost absorption, right? So there's a lot of infrastructure it takes in order just to get these robots running that are reflected in their, the service costs, but they're effectively fixed costs rather than variable. So every new robot that they deploy is not going to incur additional of these fixed costs. And so that's one of the big theses that I have for Knightscope reaching profitability. And so then all of those things combined kind of get to, it's a matter of sales. And I think they have a lot of expansion opportunities just with some of their existing clients, let alone all the future clients that we could see. And I think this really is something that grows over time, where the more robots are deployed, the more credibility they have and sort of this, more visibility they have, just because more people are seeing the robots, that this could really grow very quickly in the future, right? So it's sort of, again, not exactly the same as a network effect, but I do think there's some aspects to seeing more robots deployed actually gives them an advantage, just because they have that scale. So let me go into a bit more detail on that. So the first two things that I said were that the robots work and that they're cost effective for clients. And I think for me, that rests on two aspects. Number one is you see the actual results. And let me zoom in to this thing over here. Number one, you can see this was from the Huntington Park. It's a city in, I believe, California. Sorry, maybe Texas. I guess I'm not sure. Oh yeah, California. It's right there. And this was one of the early things that got me to invest in the company, because the chief of police here is saying these robots can do things that, officers / security guards cannot, right? And that's just because they're machines and they're robots. Same way that a computer, comparing a computer doing math versus a human doing math, the computer, it's not even a contest. It is just different. And so that's similar for these robots. They have some capabilities that, officers and security guards do not. And then their actual proven results, right? And from all of these deployments of the robots, they have these. You can read through this. It's in their investor presentation. But that here's the Los Angeles County Police Department deployed one. They went from 48 reports of crime to 26 reports in crime. In the before and after period, 46% reduction. Some of these are even more stark. Parking structure in San Francisco, they used to have 20 crimes per month. Then they went to 2 crimes in 12 months. So a 99% reduction. Again, you can look through all of these and they've reduced the number of incidents. They've deterred this, crime in these areas. So the value is there. And we also see this in the renewals. I think I pulled up this one here, where this is, I think, their oldest client that has renewed their services for an 8th year, right? And so renewing for the 8th year, what company would do this if Knightscope was not providing them value and they didn't think that this wasn't cost effective, right? They would have switched to something else. That's a long time to continue on with the same service. And I think, there are lots more examples. I don't have them pulled up right here, but you can pull up the headlines if you see clients renewing for a 6th year, a 5th year, a 3rd year, 4th year. There's quite a few of those. I think, over time, those are no longer, they're not news stories, and we're not making press releases for them because they have enough of them and it's been proven out. And so that's, the basis for me for believing that the robots that they work and that they are cost effective for at least, the right type of client. Clearly they've had some clients, here's part of the bear case. They've had some clients that have canceled, but I think, there are enough prospects out there for which the robots are cost effective and do work to reduce, to actually solve a problem that they have, that the market is very, very large and generally not penetrated. So, and that gets me to, I think the market is huge. That's another part of the core thesis here. And this is from the company themselves, is in their investor presentation. The numbers don't matter so much to me as far as whether they're accurate precisely. I think if they're even within the right order of magnitude, they're looking at this and saying, there's all these corporate campuses, healthcare, facilities, casinos, etc. All of these, and 1.8 million total prospects here. Law enforcement being the largest one, but even if it doesn't, there's some major reason why it can't, why the robots can't help out so much in law enforcement, even though we've already seen that, but maybe it won't be broadly adopted there for one reason or another. There's bureaucracy. There's still hundreds of thousands, of other facilities where the robots could. And, when there's hundreds of thousands and they deployed a couple hundred robots, the penetration in the market is tiny compared to what it could be. And so I think if you look at that, that is just a pretty straightforward analysis that, I don't think it's a stretch to say Knightscope could, without a whole lot of, without being limited by the market, they could 100x their number of deployments and still have more room to grow, right? And they're saying the long-term potential, is 360,000 robots. And I don't disagree with that, right? I think the market is absolutely huge. That's not going to happen anytime soon, right? That would be a 30-year potential, multi-decade. Let's just put it that way. But even in the near term, right, getting a couple thousand robots is significantly more scale than they have right now. And, a couple thousand robots would be less than what they're saying is the, 2% of the overall market. So I think that, to me, again, they're cost effective and there's a large enough market, really is the, fundamental piece number one of the thesis for the company. Now, then you have to go and you have to say, okay, this has been true for a while, right? That was part of the original comment from Billy was Dignity Lifts, my prior video. He or she said, they've been at this for a while. All these things I'm saying here have been true for a while. Now, one of the things that may not be obvious to you is the company effectively messed up with their prior K5 robot, right? Their K5 robot is, this one, this one right here. That's a K3 actually. Let me find the, picture of the K5. It's what I was showing before when I was showing, yeah. So all of these are, two different generations of the K5 robot. This one up here is the 3rd generation. This one down here is the 5th generation. And so the company pretty much messed up with the 4th generation. Not going to lie on that one. And I think I have, I found one of the announcements where they're talking about this. So this was a 4th generation. You haven't seen too many of those. At least I haven't. I've seen a lot of press releases. I follow the company pretty closely. You don't see this one very much. The reason why is because it didn't work very well. Again, I don't have any particular insight into, how they got to this point, but I think they lost a couple of years because the 4th generation K5 ended up not working very well. I think it was very buggy, is my understanding. They talk about this a little bit in the Innovation Week. Very, very long sessions. I had to listen through quite a lot of that to sort of get some of these new nuggets of information, at least new to me. But they talk about this a little bit, and they said the 4th generation just didn't work very well, and so they deployed a couple of them, and then they had issues. And I don't know. It's hard to say how much company time ended up getting spent and waste on this, and how much wall clock time, how many years in 2018, 2019, 2020 time frame were really kind of wasted on this generation of the K5 before they just decided to cut their losses and move on with the 5th generation, which we've seen more of the 5th generation K5s deployed now over the past couple months, I think, than we ever saw of the 4th generation. And so I think that's a large portion of explaining to you what is different now. They've been at it for a while, and the 4th generation was really kind of coming out right as they were starting to scale up. That also coincided with COVID, right? And so I just want to call that out there, that COVID killed a lot of companies, especially startups, and Knightscope made it through. They're not in the best position. They're not in as good of a position as they were beforehand. Granted, there were some issues, and I'm not going to go into all that. Maybe I'm going too far down that rabbit hole, but just explaining also why what is different now versus the past 11 years, because the company has been at it a long time. I think that was another major mitigating factor for the company was this failure of the 4th generation K5, coupled with COVID and all the knock-on effects of that and supply chain issues. I think those two together really did a number on the company. But I think they've fixed a lot of that now with the 5th generation K5, and that one has been it's now been deployed at multiple sites. It's been working very well as far as I understand it, and it is cheaper to build, it's faster to build, and that is, sorry, excuse me, I need a drink. That gets me on to, one of the next pieces of my thesis here, and that is very quickly they're going to burn through this backlog. So here's my graph of their sales backlog. Every data point here is every point that I know where they've reported what the size of their backlog was. And, I talked about this a little bit last time. At the end of 2023, when they pretty much started deploying the 5th generation K5, I don't know why it's cut off there, but they had a $2.3 million sales backlog. My understanding is that these are signed contracts where a customer or a client is ready to take the robot, or at least has signed on the dotted line that they are going to pay for the robot. Maybe there might be a couple steps that the client still needs to do in order to actually allow the robot to be deployed to their site, but that the client has been qualified and they've signed a contract, so the robot will be deployed to them. And largely, I think Knightscope was the holdup because they could not actually produce, I think it's a combination of they didn't have the production capability to build the robots fast enough, because the prior generation just took a lot more effort. They weren't quite as optimized yet, and also, on the flip side, excuse me, sorry, I need another drink. They also hadn't proven out the 5th generation K5 yet, right? So they did some pilot deployments to actually, deploy it at one site or another site and say, how is it performing? But I think they were gearing up in the background, and I called this out in my prior week's video, where they were just ramping up the amount of, this graph is for their, let's see if I can zoom out just a tad bit so you can see it. Their raw materials they had in hand, the number of robots they had in progress, right? So this has been gearing up all through 2023. And I think that's a result of them finally saying, cool, we're getting all the materials in place so that we can now actually build these K5s, right? If you're able to build them much faster, that means the amount of inventory you're going to have on hand might be a lot larger because you're burning through the inventory more quickly. And so I think I'm hoping that we see these, this amount of raw materials on the balance sheet and robots in progress actually go down, when we see the Q1, Q2, Q3 results, because they're actually assembling them in the robots and deploying them. And so, but as at the end of the year, they had, almost $4 million of raw materials on hand, and another $2 million roughly of, robots already in progress. So those $2 million worth of robots in progress is probably roughly what they needed to actually clear out the backlog. So once they build all of those and ship that, this backlog should drop very quickly down to about 0. One of the things on the flip side that I want to call out with this backlog is we've seen sometimes this backlog grew very quickly, and if I go back up here and show some of the rows between, the end of 2020 into April of 2021, that ASR backlog grew by $1.1 million. So this is bleeding over past the, hey, we can build them faster, into what we've seen in the past in terms of sales volume, right? So in 4 months, they signed $1.1 million of sales, of annual revenues worth of contracts, right? And so they deployed some of that, or maybe some cancellations. Who knows? All we know is the backlog went down. And then again, in a 3-month period, not a 2.5-month period, from the end of 2021 into the middle of March in 2022, we saw $500,000 of sales. Once again, we see some of these 3-month period between August 10th 2022 to November 2nd 2022, we see $600,000 worth of sales, right? So again, just shy of 3 months, slightly over $500,000 worth of sales. So it's not far-fetched to me when we've seen them in the past be able to sign contracts for $500,000 in 3 months. We're looking at an annualized rate of $2 million. And again, back here you saw slightly over $1 million worth of sales in a 4-month period, right? So again, that's like a $3 million per year run rate of signing new sales. It's not far-fetched to me to think that the company's gotten more and more mature in their sales process, that in 2024 we could see $4 million worth of sales signed, maybe more, right? That there's a lot of experience that they've been getting. There's a lot more legitimacy that they have to these products now, especially as they've I think they have a stronger sales case when they say, hey, we have one that's now deployed for the VA, right? That the federal government has approved us. We have FedRAMP approval where we can say the way that we handle your data is very secure. I also think they can sign more sales when they don't have a backlog. I alluded to this already, but when they have a backlog of $2 million, let's ballpark that and say that's oh gosh, I'm trying to do the math in my head. What's that? But roughly, let's just call it 40 robots, right? So here's the data point. Back then when they actually reported it, $2.5 million represented 49 robots. So if they have a $2 million backlog and that's 40 robots, if you make a new sale, what are you going to tell them for when you can actually deploy that to them? Well, you're number 41 in the line. We can build one a week at best, right? That's the state they were in until basically the end of last year, just 4 months ago. And so I have a feeling that also really slowed down sales in this 2023 timeframe, because you may have had a mix of folks who had signed that ended up canceling because they were waiting in the backlog, and people who just never actually signed because they asked during the process, okay, if we sign this contract, when are we going to get our robot? And they got an answer from the company, which was, well, 6 months, 9 months, 12 months. I don't know. It's really hard to say what the impact of that was, but I think they're going to be able to sign more sales because of that. And so this is, all trending in the right direction, I think. And again, that a lot of that stems from this new 5th generation K5. That I think is a really, really big deal. I also think the stacking on top of, of that of having the FedRAMP certification is a big deal. That's a really big, point of credibility, both to say we can handle the data properly, but also to say, we've been vetted by the federal government. This is not this is not any one company where you can say, hey, we've got great inroads with this person, or, we were able to, to fool one person in buying our robot. The federal government is doing it. And then I think, this is getting into the potential for expansions, but I think you might see expansions in the VA. The company has alluded to this, and it's not really a surprise that if the VA likes it at their one facility, they're not going to just only deploy one ever. They're going to say, all right, that works. Let's sign it. Let's get it out all 100 facilities we have here. Then you might see other federal government agencies, sign contracts for robots, try them out, and then expand. So I think some of those deals by themselves could be hundreds of robots. And so very, very quickly, you could see this backlog, or you could see sales numbers that are dwarfing what they've done in the past. They also have, I think I've mentioned this before, they have this master agreement that they signed with Penn Entertainment, to deploy these across all, 43 sites. I believe they said on some of the Innovation Week, which was, about a month ago at this point, that I think they were not even a third of the way through these. So I think just built into this contract they've already signed, I don't think this is technically in their backlog. So I don't think it is reflected in these numbers, this 2.3 million or the 1.8 million. But I think they do have this sort of master agreement where they're going through each of these 43 properties, and maybe there's 30 remaining, to talk to them about what do you need at this property. So I think that in and of itself is an already known, expansion opportunity that is also not reflected in the backlog numbers. And then, going back to the actual case acquisition, they acquired a company that had already deployed thousands of those emergency communications devices. I think they had a client list of probably maybe 1,000 clients. Those are all folks that they can potentially cross-sell the robots to, right? And so I think that client list represents a whole bunch more opportunities for expansion. Again, once they are in the point where they can call somebody up, talk to them about the robot, and sign a contract and get it deployed in very short order, when there's no real roadblocks to signing a deal, and from the client's perspective, where it all makes sense to them. And so those are all some of my reasons why I think we could see sales numbers that are much greater. And again, I'm gonna give you the same caveat I gave you at the beginning. This is high risk. Everything I'm saying depends on the company actually executing. You may be skeptical of that, and that's fine. You may be pessimistic, even at those the original comment said, I'm optimistic, they're pessimistic. That's fine. If you don't think that these are reasonable things, or you don't think these are likely things that the company will be able to do, then you should not invest in Knightscope, right? Because you'd be, it wouldn't make sense. I think that these things are quite possible and likely. So I can't tell you when they're going to happen. I am personally willing to be patient, but I see the future for the company. I see these things as very real possibilities. One other thing that I want to call out, if you are not familiar, is these unit economics. And I'm going to zoom in here because it's a great chart. This shows really, I guess I'll zoom out just a tiny bit. These are estimates, right? This is not what they've actually realized, although I'm going to talk about that in a moment. But this is roughly how, their targets for the unit economics of each robot, of each K5, let's say. And the green bars here are the revenue they get each year from that robot, right? So every year you get another, $51,000 is what they're modeling at here. And then the red bars and the orange bars here show your costs. And year one, right, before you can deploy that robot, you have to build it. That costs a lot of money, right? So in year one, you spend as much money. In fact, you spend more money, slightly more money, on the robot itself to be able to build it and potentially deploy, I guess, then you even bring in revenue. So that's bad. But then you look at year two. You don't have to build a new robot in year two. It's still operating. Year three, you don't have to build a new robot. It's still operating. And so you get to, for the lifetime of that robot, you've already paid the cost. You're not paying more costs for the robot itself. Now, you do have these orange bars here. You do have to service the robot, right? Knightscope is billing the customer for the service of having the robot operate for them. The customer is not purchasing the robot. And so as a result, when something breaks, Knightscope has to go out and ensure that it gets fixed. And they want to do that very quickly. And, so that costs them money. And so they have these models here. And again, I actually don't know how much they really spend. This is one area where I would like for the company to be more transparent. They haven't shared this to date. On one hand, I would like to see. On the other hand, I think the 5th generation K5, those are the numbers that are going to really matter for the next 5 years of the company. And frankly, no, they just don't have those numbers yet. So even if they shared it on what they got for the 3rd generation K5, the numbers they have for the 5th generation K5 going forward, they just don't have those yet. And so it's a question mark. Hopefully they can realize numbers that look somewhat close to this. If they do, right, their cash flows, their cumulative cash flows looks like this blue line, where in year one, they lose money. So from that perspective, yes, it is true that they lose money with each robot they deploy in the first year. Then in year two, if the client renews, the robot is still operating, isn't having major issues, is having just a normal amount of problems that you say, hey, we're going to have some service costs for this. Now you flip into the positive in terms of cash flows in year two. Same in year 3, year 4, year 5. Or sorry, this is not your cumulative cash flow. This is just your net cash flow each year, right? And so because otherwise this would be going up and up and up in year 3, 4, and 5. And they have the actual numbers over here. Add it all up. They say over 5 years, if a client renews, right? So they don't have to redeploy it or any of that stuff. With this model, they'd bring in $255,000 of revenue over that 5 years. Now their total costs ended up being, with this model, $84,500. So your overall margin, again, with this model is $170,000. Your overall, gross profit from that robot, 67% profit margin. That is hopefully what the 5th generation K5 can achieve. Again, by having a lower initial cost to build and lower service costs because of just, better design, right? They learned a bunch of lessons from their prior generations of the K5. And so I know that was a big focus. They've talked about that a lot. Again, time will tell if their newer design actually pans out to have these better properties or not. So if I look at that, going back to to this blog post I want to reference, where the CFO, this is the new CFO, said a lot of stuff in here. But one of the things that jumped out at me in this blog post is they did an internal analysis of existing clients who did actually renew for multiple years. And they said our highest performing clients have yielded the company close to 60% in profit margins over the course of 5 years. That is huge, right? So they are actually saying we've proven out roughly this model that we can get these high gross profit margins over a 5-year period. And so I think that is something that we need to see. And again, the 5th generation K5 hopefully will achieve this for more than just their highest performing clients. Hopefully this is for their average performing client. We'll get them to this point. And that's a really big part of what I see. I think there's, a lot of other areas where they can optimize. I do think, they talked a bit about telecommunications costs in the past. They don't split those out. I think they're significant for the company. They do say every robot generates, 90 terabytes of data every year. That data needs to be transported. Those are telecommunication costs. They don't have Wi-Fi. It all goes over cellular for the most part. And, they have to actually store that somewhere. They have to, they incur the cloud costs from that. I think some of those might be opportunities for them to optimize. I'm a software engineer, so my mind goes to how can you optimize that data. I also think that they're focused on a lot of areas of the company and improving profitability, and that's been their focus for 2024. So I am hoping that they can reduce some of those other costs that will help them realize these margins. I also think they have some fixed costs in there. And so I'm going to go back to their actual numbers and talk about this a little bit, where I said, hey, they have this service revenue. They have this cost of service revenue down here, which is higher than their actual, service revenue. So they have a negative gross loss. But what we don't know definitively is how much of this cost of the service revenue really are fixed costs, right? The folks who have to monitor the robots, the folks who are just generally on staff to deploy the robots, right? I have a feeling those are considered cost of service. Some of this is actually non-cash expenses because they have the depreciation of the robot in these. That's also one thing to keep in mind, where you'll see the cash flows look like this, where there's a major negative in year one and then positive in subsequent years. When you're actually looking at their statements of operations and the accounting, how they actually account for that, it is spread out over a long period of time. So these numbers that you even see here are not necessarily reflective of the cash flows of the company. And so that's another thing to keep in mind. In terms of operating expenses, I do think those are going to be flat, or maybe even trending slightly downwards over the near future. I'm personally lean more towards flat. We did see a reduction from 2022 to 2023. R&D down from 8.5 million to 6.3. Sales and marketing down from 8.5 million to 5.2. G&A up a bit, 11.7 up to 12.6 million dollars for the year. But again, overall operating expenses dropped by about $4 million year over year. I don't know if we're going to actually see a drop into 2024. We'll see. It's hard to really get good quarter by quarter data because, I talked about this in the prior video, their full year results sort of recharacterize some expenses from their Q1 through 3 results. So we don't actually know what Q4 looked like. When the Q1 results come out, that's going to be a pretty good data point for us to sort of extrapolate a little bit for this year. I know that the company is focused on profitability at the moment, so it's possible they could actually see, reductions even from the 2023 levels into 2024 for some of these operating expenses. A couple of things that the company, could do, right? They should have lower some of their third-party expenses they had due to trying to achieve FedRAMP certification. They finally did that. And so there will be, I imagine, some ongoing expense related to that, but it should be, I would guess, lower than what it costs to go through and achieve the FedRAMP certification up front. And so that might be another source where operating expenses could decline. But other things they could do, they talked about just being able to raise their prices on the robots a bit. And that, overnight would improve their revenue and improve their margins, right? Because if they're just getting more revenue for the same amount, the robots aren't going to ask for more money, right? They're not getting a wage increase. It doesn't cost any more to operate the robots. So if they're able to raise the price, even if they rose the prices by, 3%, 5%, that would just be, that incremental revenue is 100% profit at that point. So that is, a good thing to see. And in some senses, it's kind of like having a mortgage on your house where you lock in the cost of your house, you pay that mortgage down over, 20 or 30 years. We have fixed costs every month that you're paying, but the value of your house can continue to go up, right? So that's how you build equity, by both paying down your mortgage and having the value of your house go up, even though you're not paying more on a monthly basis, because you sort of locked in the costs. And that's how Knightscope will be locking in the cost of the robot when they build it and deploy it. But then, if there's general economic inflation over time and they can raise the price of their services they're providing, they don't have their costs aren't going up in tandem with that necessarily. So I think that's one interesting dynamic that the company does have. One little point that I'll mention today that I talked about at length in the past is that these robots are still so novel that they get free advertising for every new robot that they deploy, or for at least a lot of them. You see news stories where folks have said, this new robot was deployed here. And, Knightscope isn't paying for those. It's just newsworthy enough because folks are deploying robots, right? It's not, you don't see robots all over the place in your normal life. And so when one is deployed, it can be newsworthy, at times. It's also free advertising, not just the news story itself, but everybody who visits that establishment and sees the robot, they probably take a look at it or they're curious. And then that in and of itself is free advertising for Knightscope. And then it also gains credibility. I've talked about this where, I think having one deployed at the VA and the federal government gained some credibility, but just seeing more and more of these things over, out in the world, folks are going to start to see that this is a legitimate product, not a novelty. That it will be novel because it's maybe new to them, but it's not necessarily, it's not a gimmick, right? They'll actually see them operating. The more that you see these around, people who are in, the decision-making seat will, who have seen these operating in other companies are going to say, hey, maybe we should consider one of these. This might be a cost-effective solution, and it's not going to be near as much of a, career risk for them to say, let's bring a robot on to serve some of these functions. All right, so one other thing I wanted to go through is to sort of put some numbers to this, right? A lot of what I talked about today was, a mix of qualitative and quantitative. I want to be super, super quantitative here and strict on how much additional sales do they need before they actually start to hit break even. And so I put together a simple model. This is, I took their Q4 service revenue and cost of that service revenue to get, what was their actual gross profit in Q4, right? And so they had a gross loss, so a negative 676,000 gross profit. Here I could format these as currencies, so you can see them a little bit easier. That's how much they lost at the gross level line, the gross profit line, from their services in Q4. Now, what I did here is I modeled how much more additional sales, what if they did a certain amount of additional sales per quarter, and at specific levels of incremental profit margins, what does that look like for Knightscope in terms of now their gross profit? So if they had a 1,000 additional, service revenue, and that ended up being, 30% in terms of gross profit, that gets them to now their losses dropped from, negative 676,000 to negative 376,000, for the quarter. If that goes up to, 60% profit margin, that gets you almost to break even now. If they were to get $2 million worth of, additional sales, and if that was at, 60% gross margins for those incremental sales, that now puts them at a, gross profit from their services of a tad over $500,000 per year. So I made a whole table here. It's color coded by the red is negative, green is, positive, and darker green is more positive. And so you can see how much more sales they would need before they actually start to turn a profit. And from there, then so that's this entire table up here. From there down on row 13 to 14, I put in, this is roughly what they make every quarter from their product gross profit. This is selling the emergency communication devices. And I am not modeling this as something that's going to grow. I just figure just keep it flat. It's going to keep having the same margins it always has. It's sort of a stable business, not going to grow, not going to shrink, just stays how it is. Hopefully you believe that's, a fair assumption. Over time, as the, ASR business grows, it starts to become a rounding error. At least that's the hope. Now that I put in their line for their operating expenses, again, that was about $6 million for the year. I suppose I could format both of these also so you can see them as currencies. But $6 million for the year. That was their operating expenses. So then you subtract those off, and you have the same table down here, just mirrors the above table, except it subtracts off, it adds in those product gross profit and subtracts off the overall operating expense to get roughly what would be your EBITDA, right? So I'm not including any of those other adjustments in terms of paying back debt, those sorts of things. But if you get a rough number of what their EBITDA would be, and you can see they're still very, very much red with just an additional $1 million in quarterly sales, which is, roughly what they're going to be somewhere in this vicinity after they, go through the backlog. So even if they're able to improve things, deploy the backlog, it's fair to say they're still deeply, deeply in the negative in terms of, overall EBITDA. Even if they're at 60% profit margins, which, they may or may not actually achieve. They've said that they got to that point in their internal analysis for their highest performing clients. What is their average performing client? I don't know. What's their 5th generation K5 going to be? I don't know. So maybe, the one I've been sort of looking at is somewhere between here, the 40 to 50% profit margin, rows here. I think those are credible and realistic. But now you start to look at it and you say, okay, well, how much sales do they really need before they start to be, actually break even, actually profitable? And the numbers are pretty large. I'm not going to lie to you. So even once they get to $4 million in additional quarterly sales, they're still losing, $4.5 million per quarter. However, when we start to see this momentum, you're going to see two things happen, right? Number one, you're going to see again, they're going to be burning less cash. So they're going to need less funds to actually, they're going to have to dilute less in order to fund the company. And you're also going to see those numbers moving in the right direction. The market is going to be forward looking, because once we get to the point of, we've, doubled sales to, $2 million, or, tripled sales up to, $6 million here, where this would be $4 million in additional quarterly sales. Tripling of that revenue, that's going to be, people are going to see the numbers moving in the right direction. And so the company is going to be needing less capital because they're actually performing better. And at the same time, the market probably will be giving them a little more leeway because they're moving in the right direction. And so the cost of them, getting that capital is going to be lower. And so this is where I'm looking at as an investment. I'm looking forward in the future and saying, if they can just do this, if they can get additional sales and deliver these profit margins, we will see, the positive, sort of a positive feedback loop going on for the company. And again, you start to do the math on some of these deals. Let's just do it real quick, right? So they already have, $2.3 million backlog. They're going to clear that. That would get them, to not quite another of $1 million in additional quarterly sales. So again, clearing the backlog is going to help, but it's not going to move. It's not going to immediately move the needle to profitability. They have to perform this year. They have to actually make more sales. But, if I just roughly do the numbers, if they can deploy, 3 robots per week, $50,000 per robot, I think they did 51 in their hypothetical model. Let's just say $50,000 per robot. That means, every week they can bump this up by, $150,000. That's per year. So over, a 12-week quarter, that's $1.8 million per year. Turn back to quarterly numbers, that's, $500,000. So that's every quarter. So after, by the middle of the year, they should be at this point. By the end of the year, they should at least be by this point, if they haven't actually ramped up their deployment numbers even further. And so again, you might look at that and say, they're still losing $5.5 million per quarter at that point, but they will have narrowed the range, right? The point is they're moving in the right direction. The market is going to be forward looking, and I also think that these, again, talking back at this, what I just said was, 12 weeks, 3 robots per week, 36 robots per quarter is roughly their current rate of deployment that they can actually achieve. Those are pretty small numbers in terms of those opportunities I was saying earlier. Penn Entertainment still had, let's just call it roughly this amount, 30 something properties that that they've already signed a master agreement for, and Knightscope has not gotten around to evaluating each individual one and then building and shipping those robots. So that right there might be another, just 1 quarter's worth of deployments at their current run rate. They've already signed this master agreement with Penn Entertainment. The VA, gets you to, I think they said roughly 140 more VA hospitals. So if they like the robot that is deployed, it performs for them after 6 months, they say, hey, it's working. It avoided us having to hire another, security guard, or it solved this problem for us. It deterred these issues, whatever their real rationale is. They say, I'd like one at every campus. That's 140, right? At their current run rate of 3 weeks, that's a whole year's worth of deployments. That's why increasing their ability to deploy every week is important. That's why ramping it up even further to, they said they're trying to ramp it up to 5 per week by the end of this year is important, and so again, 140 robots, $50,000 per year. And I actually think these ones are going to generate more revenue because those are a more complex robot. They had to do a little bit more in the internals there. They talk about that, where they had this, additional K5 model for the federal government to actually achieve some of those more stringent FedRAMP requirements. That right there is $7 million, turning to quarterly revenue. That's, moving you over 2 columns here, or, it's getting you almost $2 million in quarterly revenue if they sign that additional deal with the VA, right? And so this is where I don't think it's ridiculous for me to have rows where I say, or columns of, $2 million, $4 million, $8 million in additional sales. It doesn't take that many deals. Again, these are robots. These numbers are still small compared to, go back to this chart, 36,000 robots, right? That's a humongous number. And again, that's not going to happen this year or next year. But the point is, they can sign deals that are much larger than where they're at today and still just be scratching the surface. So this is why, this is the bullish case for the company. This is why I'm holding my shares. Coming back here, if you really want to get to the point to say, hey, when do they start to get profitable, wildly profitable? If they hit these 50% profit margins, they get profitable somewhere around $12 million. Let's call it maybe $13 million in, let's just make it 13 million. $13 million is where they basically break even in additional quarterly sales. That's a lot. I'm not lying to you. So 13, that'd be 52 million in annual sales. And again, that may sound like a ridiculous number. And I don't think they're going to get there in a year. I actually think they're, and I'm going to talk about this in a second. They say they're targeting profitability right this year. They're not going to get there by, selling an additional $52 million in annual, annual contracts, because that would be, 1,000 more robots. That's not going to happen this year. However, I want to call one other thing out. There's a big assumption here that I made, which is their operating expenses stay the same. There's a chance they're going to cut further. And I already talked about this. Some of their FedRAMP expenses may go down. Some of their G&A expenses may go down. Sales and marketing, who knows? Like, it's really hard to say. We're not going to see what those numbers even look like to have a good picture until Q1 results come out in, what that would be, about a month, I think. But if we drop this down to $5 million, now they start to get profitability even sooner. You're talking more like, somewhere closer to 10, what's that, $11 million in quarterly sales. So you've knocked off a fair bit. If they were able to get to that 60% profit margin consistently across, all of their new robots, you're talking, at $10 million, they are profitable. Hi, Transient Stacker. Thanks for hopping on the stream. Just talking about Knightscope today. I'm actually almost done, so sorry if you're just now hopping on. If you have any questions or comments, I'm happy to chat about whatever. Because I'm going to be done with this material in just a minute or two. But, tying this all together, or concluding, they've got the backlog, they're going to deploy that. They've got lots of expansion potential, they're going to deploy that. And then I also didn't talk about they might be able to improve the, you know, margins on what they're already doing. I sort of assume that whatever they're doing right now, these are all kind of mostly fixed costs, but it's possible they could optimize that as well. You know, they've already got a number of deployments. Maybe some of these are the third generation. Maybe by deploying the fifth generation, they will actually improve their margins on those. It's hard to say. You know, if they actually were able to deploy, or if they were to lower those costs from their existing ones, maybe this comes in the form of better, you know, lower telecommunication rates, whatever. If we drop this down and let's say they get it just even to break even, you know, if we get this down, I'm just going to edit this out. Well, I suppose I could do this and say, let's say we get the cost down to $17.92. So they start off and they're at, you know, no gross loss. Now all of a sudden you start to get profitable a little bit sooner. I guess maybe it's not that big of an impact because, you know, they still have quite a bit of operating expenses. But I'm just saying, like, there's a lot of levers they can pull. And so I actually think it's pretty aspirational for them to get break even by the end of this year. And they might do it. Maybe they'll have more stock-based compensation. You know, maybe it'll be a, hey, we're technically cash flow break even though we're not, you know, net income positive quite yet. But I think those are, that would be a good milestone. But again, I do see this path. I see it sort of being a snowball where once they start having this positive momentum, the impact on the stock in terms of the capital they need and the rate at which they're diluting will go down. Sales will be moving in the right direction. And in terms of an investment, once things start to turn the corner, you don't actually have to be cash flow positive. You don't have to be net income positive for the stock to start to move in the right direction. I mean, you may need that if you really want the stock to explode, but I do think that you're going to, you know, once you see things moving in the right direction, you'll see it recognized, you know, in the stock as an investment, and that will be, again, a positive snowball. So that is roughly as best as I can say, my full, you know, bull case for the company. Thatcher's World says, appreciate your coverage on Knightscope today. Dustin, out of all the stocks you cover in your channel, which ones are you adding to at current valuations? So number one, this is not investment advice. So don't take it from, you know, don't invest on anything. This is just what I'm doing. I have a sizable position already in Knightscope. So let me give you some general context on my investing style. My investing style is I like to put a sizable portion in companies. I will add more over time until I get to kind of like roughly the number of shares that I want. And then I intend to hold those for a very, very long time, either until the stock gets to my very long-term valuation, for which I'm willing to hold stocks for, you know, 10 to 20 years, you know, for a long, long time, or until something about my original thesis breaks. So stocks going down does not break my thesis. Something like them changing their business model, or something that I originally assumed was going to be part of my long-term thesis for the company, you know, breaking, is, you know, it gets me to the point where I, you know, that's at the point where I will reevaluate and maybe sell. You know, prior example for, I covered Inviva. They were a wood pellet producer, and, you know, I had a very clear, that one necessarily wasn't intended to be a long-term hold. That was one of the few stocks that I actually purchased because just the valuation I didn't think made sense, and I did intend to sell it on a shorter period of time, at least a portion of it. But like, they got to a point where it was clear that the company was going to majorly go bankrupt, or had a major risk of bankruptcy, or have to dilute a whole bunch. And that was not a part of my core thesis. My core thesis was that they were already a profitable company that just wasn't being recognized by the market. So once I realized that sort of thesis broke, I sold out. So again, with that investing style in mind, where I like to, I sort of set a target for the number of shares that I want based off of what I think the long-term value of those shares will get to in, you know, a 10 to 20 year time frame. And once I get those shares, I just chill, basically. I set those aside, and then I keep investing and find new companies that I want to invest in. So long-winded answer. To answer your question, what am I currently adding to? I'm not adding Knightscope simply because I have enough shares. I've over the course, you know, I've been invested for a while. I've added more after they, I invested before they went public. I've added more after they went public. I have a number of shares I'm comfortable with right now. Even if I think it's going to go up, like it already represents enough for me. If the company does what I think it will do, I'll be very, very happy with the shares that I have. So what I'm adding to today at current valuations, I am adding to, I just finished my Palantir position. It went up further, up faster than I wanted. And so I was sort of dollar cost averaging into Palantir to get the number of shares that I wanted. I didn't quite get to that point. It went, blew past $20, up to $20 and past $20. It's been there for a while. And now that it's gone back down to the $21 range, I'm adding more there. That may or may not be, I was enthusiastically purchasing it when it was, half of that. It was down $10 range. Somewhere in there, I was buying a lot. But I still never got the amount of shares that I wanted. So that's one I've been adding to. I've been adding to Rocket Labs recently. That one's a smaller position for me because there's still a lot of risk with Rocket Lab. I think the space sector, I've done some research, but I do not understand it as much as I wish that I did. But there's just a lot there. But I do think Rocket Lab has a ton of potential. The major risk for them obviously is SpaceX. To what degree is SpaceX going to end up killing their business just because they are, they have that much more scale, that much more further, progress in terms of their actual launch capabilities. And then what are they going to do in terms of the Neutron rocket? And again, this isn't really a Rocket Lab focused stream, but I have others of those. That's one that I'm adding to right now, especially as they've dropped down. I've been very happy to purchase more shares around the the $350 range or $350 range. Anything under $4 I think is pretty good. And again, once I get to a certain number of shares, my target number of shares for that one, which I'm at about 75% right now, I will probably be done with that. So those are the two recently that I've been adding to. I've also been adding to, it's not a stock, you didn't ask about this, but I've been adding Bitcoin. That's another one that I personally believe in. And again, like I say, for Knightscope, since this is a Knightscope focused stream, and I see there's, one other person here, the Cuban says, Dustin, I kept Knightscope and I've added more shares. I believe they're going to deliver. Look, for my sake and for your sake, I hope so. Again, I think I recall your comment previously. This is a high risk investment, so make sure that it's money you can afford to lose. I will reiterate that pretty strongly with Knightscope specifically because they are not yet a profitable company. They continue to have to, issue shares and, issue debt to a lesser degree in order to fund the company. On the flip side, I do think I'm invested in it. I'm not telling anyone else to invest in it, and I'm not telling you to invest it or not to invest in it. You need to do your own research, before you decide what to do. I am calling it out that it is a high risk company, or is high risk investment. But yes, I personally think that Knightscope has quite a bit of potential. The question is really going to be, how do they execute this year? I think this year is really a make or break for the company. A year from now, if they are still struggling, they have not actually improved sales significantly, and if their margins still look abysmal, if their sales don't improve, or if sales do go up, but their margins don't look any better, even if at, sort of double the current sales numbers, that's where I'm going to start to have some major questions about, my thesis, because a big part of my thesis is that as the revenue scales, the margins will improve. If the revenue scales up, but the margins don't improve, that's not good. If the revenue never scales up, then the margins are not going to improve. That's also not good. So, again, very high risk, but, I do think that's very high risk, but I personally think there's potential. All right, let me take a drink. Another comment. Sorry if I mispronounce. Anwar Burgess says, would it be legal to, I assume that's dump the bond offering money into the stock just to squeeze out the shorts? So first of all, I'm not a financial professional. I think that would be not legal for sort of two reasons, right? Number one, when they offer the bond, they have to file with the SEC, what what are the proceeds for this bonds being used for? And if they didn't include that in there as something that they could use the proceeds for, then they couldn't do that. I think another thing would be, in order to actually repurchase stock, they have to, I guess I'm not sure if a board of directors has to authorize that or if something needs to be filed with the SEC, but I'm guessing there's some sort of filing that needs to be done before that could happen. I'm not sure, but I would guess that there is. I don't think that that would even be a smart thing for them to do at the current moment because, you know, the amount of capital they had from the bonds is probably not nearly as much as the capital that the folks, you know, who are shorting the stock have. I mean, just throwing that out there. You know, there are tons of investment funds that have, you know, $50 million, $100 million or more of capital at their disposal. And, you know, Knightscope's bond offering was, you know, they ended up closing, was it $5 million or so. You know, it's just not enough to play investment games with that. So, you know, the company just needs to focus on executing, in my opinion. So, I mean, I like the sentiment in the sense that, you know, that's one other component. Let's talk about that for a second. There is significant short interest in Knightscope. Let's find the, yeah, where's it at? Short interest here. You can look it up here in the actual NASDAQ site. And, you know, at the end of March, again, because we only get these numbers reported on delayed basis, there were 6.2 million shares short. I think in terms of the overall stock, that's what, maybe that's 8%, 7%, somewhere in that vicinity. So it's not huge anymore. Like, it used to be higher as a percent of the outstanding shares. But it is, you know, it is significant. If the company delivers and the stock does continue to go up, or does go up, I shouldn't say continue to, it hasn't recently, but if it does go up, you know, these folks will sooner or later probably close out their short positions if the company is rising due to improved fundamentals. And so that is another small part of, you know, every company that I'm invested in. That is something that I do take a small look at, because if I'm investing for fundamental reasons, I think the company will start to deliver and, you know, have more revenue, have more profits. Sooner or later, people who are short the stock, you know, are going to see that they were wrong, and they're going to have to close that out. And so that is, you know, will eventually, or it could eventually provide a tailwind to the stock itself. Yeah. The Cuban says, understood. Thank you for your insight. Yeah. And again, I'm speaking to you specifically, not trying to give you advice, but just saying, you know, because I vaguely recall the comment, I'm pretty sure it was you, where you said, hey, I think I'm a fairly new investor. I've got some money to invest. Knightscope is a very high risk one. I would just say, you know, I'll give you the context. Like, I have investments in multiple different companies. You know, I size my positions, and I'm not willing to disclose exactly how much I have in which companies, but, you know, I have, you know, less than, I guess maybe I don't want to say a specific amount, you know, but I have investments in a number of different companies. There's no, my largest position of all companies, and is not Knightscope, is probably 30% of my overall portfolio. And so you can extrapolate from there, where the other companies downstream of that are, you know, smaller and smaller portions of my overall portfolio. So, you know, just keep that in mind in terms of how you invest. You know, you don't have to just pick one stock and invest in only that one, right? You want to size your positions to what your level of conviction that you have in that one company, and also relative to your level of conviction that you have in other companies out there. You know, it's not a bad idea, you know, if you don't feel comfortable managing all of your money yourself by individual stock picking, to put some of your money just in index funds, right? S&P index fund. You buy the, what is it, the SPY or the Vanguard fund, or Fidelity fund, or any one of those that is just a broad-based index fund that has low fees. You know, that's the advice that I give to some of my family members, is to say, you know, just put your money in those. Or if you want to pick some stocks as you're sort of learning and getting into it, like, I've been reading, you know, financial stuff as a hobby, as effectively like a part-time job for years and years, right? For 5+ years, maybe 10 years. I don't know. I'd have to count it up. It's been a while. I feel comfortable investing my money in individual companies for a large portion of my portfolio. But I think, if you're not quite as confident at that, one thing that you could consider is say, hey, maybe I'll put half of my money or 2/3 or 1/3, whatever you want to do, in broad-based index funds, and then take the rest of it, the remaining half of my money or 1/3 of my money or whatever, and invest that portion in individual stocks. And so, over time, you will have at least some amount of your money where you say, you know what, I'm, at least based on history, safer, definitely more diversified by having some of my money in the S&P 500 or in some other broad-based index fund. And then I will do my best to try to manage the rest of my money, because trading and investing, it's really hard, and it tests your conviction. When you're investing in a company, it's sometimes easy to buy, but it's hard to hold, right? Because maybe I know there's people who are buying. Well, I'm not going to pull up any charts, but stocks go up and down and up and down, and sometimes they go down for a while and then they go up. I would even say, look, I'll pull up Palantir just because Knightscope it's such a new company. It swings wildly. It's not profitable yet, so that one is it's not a great example. I mean, it is it's its own thing. But if I go to Palantir here, right? So they DPO'd at around $10 quite a while ago in 2020, and then the stock shot up, and it became a very popular stock. People were buying it in the $25 range, and it was all the way. Clearly, somebody was buying up at 35, and I think it even peaked at like $40 or something, $45 back in January 2021. There's a lot going on at the time. So, but I mean, back then it was pretty clear. That was a very, very rich valuation for the company. Even in the mid 20s, when it was a rich valuation for this company. And so a lot of people might have bought here, and I hear lots of people say, man, I have such conviction in the stock. And so maybe they bought here, at 26, and it drops down to 21, and they're like, whatever, I'm fine. I'm going to hold it for the next 10 years. It's hard to hold when the stock goes down and down and down and down and down, and it's flat here at, 1/3 the price that you purchased it at. And some people, I'm sure, purchased around here in the 20s, and then we saw this and saw it, just sitting here day after day, $7, $6, $7, $6, sold. I'm sure there's somebody who did this, who sold in, late 2022, early 2023, and missed out all of the run up back up here to where it got to the point where it is, and, could go even further higher in the future. Who knows? But like, I'm pulling this up to sort of say, stocks can go down for a while. This one was in the 20s and the 30s, and then went down into $6, $8, range. And it was there for about a year, from the middle of, it first dropped below $10, looks like in July of 2022. Didn't break back up above that until, May of 2023. So almost a full year, 10 months. And it's hard. It's easy to look at on this graph. It's hard when you're seeing it day after day after day, and you say, man, I'm down 60% on this company. I still think it's a good company. I still think 10 years from now it's going to be, it's going to be worth $100 or whatever. I think it's going to do very well. But just day after day, seeing it at these low prices, seeing your loss, it's hard to do. This is something where you really have to have conviction. That's why I say trading is hard, investing is hard. And you have to know what you're investing in. You have to be confident in that. And, personally for me, I gain my confidence by, reading everything that I can about the company, by digging in, by understanding it as deeply as I can, and then forming an opinion on that. And knowing that I have all the same information as everyone else, right? If the stock goes down because everybody else has the same information as me, but now they just changed their minds and said it's not worth, $26, it's worth $6. If I think it's actually worth, $26, then I would continue buying. And again, Palantir is one where I sort of started buying here when it was around $21 and was buying all the way down. And, personally, for me, I timed it fairly well, and I had a false sense of security because I kept buying around here, $7, $8, and really wanted, I thought I was going to have more time to buy down here before it jumped up to, 15 and up to 20. I kept thinking it was going to drop down. And so that's why I said, answering the prior question of, what are you currently buying? This is one that I'm currently buying, but I'm almost done now. I think, and I stopped buying here once it hit, when it had this big gap up from 17 up to, 24. I think I bought some right before that earnings, somewhere around 16 or 17, and then jumped up. And then I haven't bought until just recently, just the past, week or two. I bought down at right 22 or 21, somewhere around there. And I'm almost have the full position there. But the point that I was trying to make, I kind of get long-winded sometimes, so I'm sorry about that. But the point that I'm trying to make here is, stocks can trade down. So the way that I approach this, the only reliable way that I know how to do this, I cannot trade short term. I'm awful at it. I think most people are awful at it. I have no advice for if you want to try to hold something for 3 months or 6 months and then sell. Like, I think you are totally up to the whims of the market. But my approach is, I want to look and see, where's the company going long term? What could this company achieve, 5 or even more to the point, 10 years out from now? Realistically, do I think they can achieve that? Why this company, right? So you have to answer a couple of questions. Why is this company going to do that rather than someone else? What can they actually do in 10 years realistically? And then from that, I sort of look at it and I say, yes, I want to invest in this company, or no, I don't. And if I do, I say, what are they going to be worth 10 years from now if they get to that point? Just a range, right? You're never going to know. You're never going to nail it or even be, but if you're within plus or minus, 50%, right? If I look at it and I say, Palantir is currently trading at $20.47. And again, I don't have my model in front of me, but maybe if I think in 10 years from now, they're going to be worth, somewhere between, $70 to $150 per share, which again, I'm not stating that, this is just an example. But if I think that, I'll look at my calculation and say, well, it's going to be somewhere around $100 per share. That's good enough for me. Maybe I want to have, 2,000 shares so that when that happens, that would be, what's that? $200,000 if I can do the math properly. So if I want this to try to be that point, then I'll say, cool, I want to add until I get 2,000 shares. And I'll try to time my purchases, but in general, I dollar cost average a lot. I was buying more down here because I really thought they were undervalued. But even up here, I continued buying. Once it got up to, 13, 12, I was buying all in this range. Again, I did kind of stop up here. I thought it was a little bit overvalued once it hit the mid 20s. This is, again, just telling you what I've done for this stock, just as an example, because it's the one that recently I have been accumulating. So I can tell you these numbers. I have them right in my head. Not my long-term target for that, but where I've been purchasing. But again, I'm almost at the point where I've got all the shares that I want. And then I'm just going to sit there on this money or on those shares. And I intend to let it happen over the next 10 years. And I will follow the company. And then as long as they seem to be performing, nothing's broken about my original thesis for what I think they're going to be able to do, over a 10-year period, I just hold those shares. And if I've already got the position size that I want, I don't add to it because I don't need to. I just let them sit and I wait for that to happen 10 years from now. And so then I'm looking for new companies where I want to also invest in them because, my goal is to have some diversification. I don't want to only invest in one stock. So, sorry, super, super long answer. Hopefully that was helpful for you. See, there's a couple of folks on the stream. If there's any other questions or comments, I'm, effectively all done for today. If I don't see any questions or comments here, just as a general note, while I give you all a minute to see if you, have any other anything else to say. I do these streams. I try to do them every Sunday in the afternoon time, Eastern U.S. time. So I'm happy to, take questions, comments, take, suggestions of what you want. I think that the next topic that I had that somebody, I think it was Walkaza, one of my regular viewers, he was requesting me to look at a company called Rich Tech Robotics, and I just started looking at them. Don't have anything to share yet. I'm going to try to do that stream hopefully next week. That we took RR for anybody who's curious. I don't know anything about them. Again, that was just one that was requested. If you have other things that you're curious about, would like me to take a look at, I'm always curious about things. Would like to look at that. Another question. So this is a Knightscope question. I should probably go back here so we see some cool Knightscope visuals. Get us on point here. Anwar Burgess asks, what do you think about the $1 NASDAQ compliance? So it's a good question. My opinion on this, and again, I don't have any inside knowledge. I don't know what the company is really going to do, but my guess is they are going to stay listed just because they're going to apply for an extension or appeal for an extension, whatever the process is, to get a 180-day extension from NASDAQ. That is I base that opinion on two things. Number one, I think the company, again, this is me putting myself in the shoes of, trying to get in the mind of, Bill and the company, and say, how should we handle this? If they are really going to do what I think they're going to do in terms of, deploying their backlog, having, seeing things improve, being able to say, hey, we're finally growing our ASR revenue. Hey, our margins are actually improving. The market is going to be forward looking on that and is going to give them credit for it. That's my opinion. Don't know for sure, but that is, I think, the hope. And, between now and 180 days from now, they're going to report Q1 and Q2 earnings, maybe even Q3, depending on exactly the timing of everything. So if they had 3 more quarters showing positive momentum, they're able to make some pretty big announcements, especially, if they show positive numbers in those 3 quarterly reports, or 2 or 3, and then they have headlines where they've signed additional expansions. If they get that expansion with the VA, or they sign another federal agency, or they get another one of their clients to expand and say, hey, we've deployed a Knightscope robot for a year. That was our pilot year, or 6 months. That was our pilot. It was successful. Now we're going to deploy to another 20 locations, another 30 locations, something like that. Those headlines are going to stack up. The market is going to see the trajectory of the company. They're going to say, okay, this is really, they're moving in the right direction. That in and of itself might be enough to get the company above $1, just because they're actually starting to execute. And so I think having that additional, 180 days is probably what they're going to try to do, if they truly believe that they're at an inflection point, the same way that I think that they are. The other part of me thinking that is, if you search and you say, NASDAQ listing 180-day extension granted. I don't know why they added that on here. If you just search for this, you can see story after story of all of these companies being granted this 180 expansion, that are all from like the past, year or two, right? All these companies, SciSpark granted, that was in September 2023. Oblong granted. I don't know these companies at all. I don't know any of them, but you can see these have all been granted. All these companies did get that, additional 180 days granted from NASDAQ. And so there's just tons and tons of these. And so it's hard for me to see where Knightscope wouldn't be extended the same courtesy that all of these companies have. So again, I think Knightscope, if I was an insider and I believe the company is going to perform well over the next 6 months, and I know that NASDAQ is very, very, generous with giving out these 6-month extensions, by all means, that is the course of action that I would do. So that's what I think is most likely for the company to do. And again, what will happen 180 days after that, we'll see, right? If the stock doesn't go up above $1, then they face the same problem, of course. And at that point, you're probably talking a reverse split or something. But if the company hasn't been performing over those 6 months, like, as investors, we're all going to have bigger issues than, are they going to get delisted from NASDAQ? Because, if the company is performing, then, fundamentals drive the actual stock performance. So, yep. That's what I think about that. The Cuban asks, do you believe it's still good to get shares from Palantir? So Palantir is in my opinion, a very solid company. Again, I'm not trying to give investment advice. It is one that I like. It is one of my largest positions personally. I have a couple prior. I think I have one a couple months ago, before the Q1 earnings, maybe one after the Q1 earnings. I don't recall. Focused on Palantir, that should help get you some overview if you're curious about the company and want to sort of get an overview of the financials. So again, I'm not going to give you advice on it, but I will say I have been purchasing right around these prices here, in the $21 range recently. I plan to hold those shares for a long time. I think Palantir is a great company for me to invest in. Again, not going to give you investment advice. It's a very tricky thing. There's also a lot of other content creators out there that have pretty good content on Palantir. So if you search for that on, YouTube or wherever else you want to find stuff, about stocks, you'll find a lot of coverage of Palantir. People who go in significantly more depth than me, and it is a very complex company. But so I know I'm not directly answering your question, but I'm trying to point you to where you can get more resources. Like I said, I have some prior streams about Palantir. I have one from, again, a couple months ago. If you just search through my channel, you could find that there to get some overview of the company. And there's much more. There's like a weekly YouTube show, Palantir Weekly, that a guy called Amit does, and they talk in great depth. So jumping into that might be a bit too much if you don't know anything about the company. But it's fun to watch that from time to time. They sort of cover every minute detail of the company every time they're mentioned ever pretty much. So, but that's all to say, there's a lot of resources out there to help you make a good decision on that one, or to help make your own decision on Palantir, I should say. So all for me will say is I am almost have all the shares that I want, and it is, I think, my largest stock position at the moment. Yeah. I also have a very large position in Bitcoin, as I mentioned, but that is a much more complex topic. I have some prior streams talking about Bitcoin as well. I do think that's very interesting, and it's something that's, I won't give investment advice, but again, for me personally, I hold some Bitcoin. So, all right, that is a pretty long stream for me. I think this might be my longest stream ever. I think I'm gonna hop off if I don't see anything else in the next 20-30 seconds here. It's been great to have some back and forth here. I really appreciate that. So, as I said, I try to do these streams every Sunday afternoon Eastern US time. So if you ever want to drop in when I'm doing it, I do try to post them a tiny bit ahead of time on Twitter and YouTube, but sometimes I can't do too much ahead of time. I kind of just have to hop on when I get time. I don't know about you guys, but my life is pretty busy. But all right, I don't see anything else, so I'm gonna hop off. Thank you everyone who joined today. I really appreciate it. This was great, and have a good one.